Okay, so let's start. Short-term financing planning. We what are the key concepts we're going to understand in this chapter is understand the operating and cash cycle. So we're going to talk about how we determine the cash cycle, what is an operating cycle, and we also see that turnover of receivables and turnovers of payable. And by this way, we'll see that the how this cash cycle is operating. Know the different types of short-term financing policies that the firms or the corporations can adopt for meeting their short-term requirements. Uh, Understand the essentials of a short-term financial planning. That's also one of the objective of this chapter, to learn, know the sources and uses of cash on the statement of cash in the financial position, and also know the different types of short-term borrowing. These are the outcomes that we're going to talk. Tracing and cash and net working capital. That's the first objective of this chapter is operating cycle and the cash cycle. Some aspects of short-term financial policy, the cash budget. So the second part, as I divide this whole chapter into two parts. So first part is focusing on working capital and cash cycle and operating cycle. And we see that how it works. And in the second part, we're going to focus on our cash budget. Why it is important for short-term financial planning. It is important that we have a well-crafted cash budget and short-term borrowing, if we based on our cash budget, whether we need a short-term borrowing or not. And then we conclude this whole discussion. So first of all, we see that what is why do we need cash, and where do we gonna spend this cash? Or from where we can generate the cash as well. So statement of change in the financial position. Uh, let's assume we are talking in a way that if we look at the statement of financial position. So first of all, imagine a balance sheet or a statement of financial position. On one side, we have a current assets, then we have a fixed assets, then we have a intangible assets, and all together we have a asset side of the balance sheet or statement of financial position. On the liability side and the owner's equity side, first we have a current assets, current liabilities, and then we have a long-term liabilities, and then we have a equity. And in equity, we have a retained earning and capital and all these things. So this is a broadest structure of a balance sheet. Now, if we look at very carefully, what is a working capital? What is the definition of working capital? Working capital definition is a difference between current assets and current liabilities. So if we adjust these current assets and the current liabilities, so what is left is working capital. Now, working capital plus fixed asset, that's on the asset side, should be equal to long-term debts and equity. You get my point? That's a balance sheet. We know that in a balance sheet equation, if I write it here, I don't know you can see it or not, but if I write it here, we have a current assets plus fixed assets plus intangible assets, intangible assets, intangible assets is equal to current liabilities, right? CL, we can write it like a CL plus long-term debt plus owner's equity or equity. Right, this is the way that we have. Now what we did, we adjust this against this so that we have a net working capital plus these fixed and intangible assets all together is a asset side, or and this one is long-term debt plus equity is our liability side. So this is the way that I want to explain you the first equation. So I hope you understand the whole idea of this, the first equation. The second equation is again, we are using the same approach here. Net working capital. Now, net working capital, what we are doing, we are rearranging these. So net working capital is equal to cash plus other current assets minus current liabilities, right? So how do we calculate working capital? Current assets minus current liabilities. Now, what we are doing, we are trying to figure it out net working capital, and net working capital is cash and other current assets minus current liabilities, that is net working capital. We just divide this current assets into two portions, cash plus other current assets minus current liabilities, that is net working capital. The objective is to see that what is going to happen. Now we have these two equations. We have these two equations. One is we derive from the statement of financial position. The other one is just a formula for calculating net working capital. Now we plug in this cash plus other current assets minus current liabilities in place of net working capital, and then rearrange and see that how we can calculate the cash. You get my point? Out of these two equations, we plug in the net working capital in equation 1 and then rearrange it so that how we can calculate the cash. So cash is equal to long-term debt plus equity plus current liabilities minus current assets other than cash minus fixed asset. So this is the way that we can calculate cash. Cash is long-term debt plus equity plus current liabilities minus current assets other than cash minus fixed assets. So sources and uses of cash, we are continuing on the same idea that how we can generate cash. So the one way that we can generate cash is we borrow. And when we borrow, what is going to happen? Increase long-term debt. The other way that we can generate cash is sell equity certificates, and that's increase in equity. We sell shares or stocks, and then we can generate cash. Or we can borrow in the short run, or we can that's a way that we can borrow in the short term as well. So increase in long-term debt, equity, or current liabilities, that is the source of cash for a business. The other source of cash for business is decrease in current assets, means we have an inventory, we have some assets, we can sell it, and by this way, or accounts receivable, that's going to decrease. That decrease means that we are generating cash. Decrease in inventory, current assets means inventory or accounts receivable, right? Other than cash or fixed assets. So that's a decrease in current assets other than cash or fixed assets. Now, what are the uses of cash? It's very opposite to that. A decrease in long-term debts means we are paying back our debt, long-term debt, or we are buying back the equities, or we are paying or redeeming our equity certificates, or current liabilities, or reduction in current liabilities. So we are reducing our accounts payable or notes payable. Now, increase current assets other than cash or fixed assets. So it is also possible that we can use cash to buy assets, which can be a fixed asset, which can be other than cash, current assets as well. So this is the way that we can use, or we can get cash. So cash inflows, source of cash. Cash outflows is a use of cash. So how the cash is going to comes in if we increase the liabilities, long-term and current, as well as equity, or we can generate by decreasing the current assets by selling it, or a decrease in other cash, other than cash, current assets and fixed assets. What are the uses? Decrease long-term debt, equity, or current liabilities, or increase in fixed assets or other than cash, current assets. Now we are saying that every business has an operating cycle, how it operates. Now, when we are saying operating cycle, it is a time between purchasing the inventory and the collecting the cash. Means purchasing an inventory, process it, sell it, and then you can collect the money from your customers. So this is the way that it's work with operating cycle. Starting from the point when we start purchasing, it means that we are spending or we borrow, we take on credit. This is the time, start time, and then end time is when we recover money from our customers. So this is the whole, we call it as an operating cycle. But operating cycle has a inventory period, like in which we convert the inventory into the sales, and time required to purchase and sell the inventory. And then accounts receivable period. It's a time to collect on credit sales. And then we have a operating cycle. Inventory period plus account receivable period is our operating cycle. Inventory period, and from inventory to sales and sales to collection, that's a called as an operating cycle. Now, cash cycle is different than operating cycle. Cash cycle is time period for which we need to finance our inventory. Difference between when we receive cash from the sale and when we have to pay the payables, right? For inventory. Accounts payable period, time period purchase of inventory and payment for the inventory. So if we want to calculate cash cycle, this is an operating cycle minus the accounts payable period. So graphically, we can present this cash flow timeline in a way. You see, there is a one which we call it as an operating cycle. Now, overall, we started from the inventory purchased this point, inventory purchase from this point, and this is the time that we are getting cash. We are making sales here. So this is an inventory period and this is an account receivable period. So this inventory period plus account receivable period is our operating cycle. Now, this out of this whole inventory period, when we subtract the accounts payable period, that period is called as a cash cycle period. You know, when we pay cash is at this time, like it's from, for example, we are receiving a accounts payable on 90 days. So we are making payment after 90 days. And we are also selling the goods on 90 days. So this is a 90 days period, but there is some few days in which we process this inventory to convert it into our product and sell it. That period is also part of that cash cycle, like that's cash is out for that. So let's discuss this example and try to understand the whole idea of this cash cycle and operating cycle and inventory turnover or accounts receivable turnover or accounts payable turnover. So we have an information here that we have an inventory in the beginning, which is 5,000. Inventory at the end, we have a 6,000. Accounts receivable beginning 4,000, ending 5,000. Accounts payable beginning 2,200, ending 3,500. Net sales, which is all on credit, is 30,000. Cost of goods sold is 12,000. And now we have further information. What we can calculate is inventory period. And first of all, we have to calculate average inventory. Inventory period is dependent on average inventory and divide the 365 so that we can get it an inventory period. So average inventory, inventory turnover, and then divide the 360 with the inventory turnover. So average inventory is 5,500. And how much is of the sales? Inventory turnover is 12,000. Is cost of goods sold. Cost of goods sold divided by inventory turnover, and we get it 2.18 times, and we divide the 365 with 2.8. So we see that our inventory period is 167 days. So how we calculate inventory period? First, we calculate average inventory, beginning plus ending divided by 2. Then we calculate the inventory turnover by cost of goods sold divided by inventory, average inventory, and we get it 2.18. And then we calculate the inventory period, 365 divided by inventory turnover, and that's 167 days. Then we calculate receivable period. Average receivable is 4,000 plus 5,000 divided by 2 is 4,500. Receivable turnover is sales, which is 30,000 divided by average receivable, 6.67 times. Now we can calculate receivable period. That is 365 divided by 6.67, which is 55 days. So you remember that what is an operating cycle? Operating cycle is inventory period plus receivable period. That is our operating cycle. So operating cycle is 222 days. Receivable and inventory period is all together is become an operating cycle. Now we want to find out cash cycle. So how we can do it? We have to find out payable period. That's an average payable. 2,200 plus 3,500 divided by 2 is 2,850. And then we calculate payable turnover. That is again with the cost of goods sold. So cost of goods sold divided by payable, average payable, and we get it 4.21. And then we calculate the payable period, and which is 365 divided by payable turnover, and we get 87 days. So we remember that operating cycle minus payable period is our cash cycle. So cash cycle is operating cycle minus payable period is cash cycle, which is 135 days. So cash cycle is 135 days for this example. We have to finance our inventory for 135 days. Why? Because the remaining overall it is 222 days. You see here, operating cycle is 222 days. But we have to cover only this because the remaining days are available through payable period, right? So remaining. So size of investment in current assets, flexible, maintaining a high ratio of current assets to. So there are different policies that we can adopt. Whether size of investment in current assets, it can be a flexible policy or it can be a restrictive policy. So if we are following a flexible, maintaining a high ratio of current assets to sales, so that we are very much in a safe period. But if we are following a restrictive, so we try to maintain a low ratio of current assets to sales. How we can finance our current assets? Flexible policy, less short-term debt and long-term, more long-term debt. So again, this is going to give us some flexibility and relaxation that there is no tension. But under restrictive, more short-term debt and long-term, less long-term debt. So what is the impact of this flexible or a restrictive policy? Managing short-term assets involves a trade-off between carrying cost and a shortage cost. Now, carrying cost means that if you borrowed and keep a high percentage of current assets, in this case, we are bearing a cost which is called as a carrying cost. And if we are not keeping the high current assets, what is going to happen? We may lose the customers, and that is going to affect our sales. We have to return the customers without providing the goods because we keep the inventory low. In that case, what is the cost is that what we call it as a shortage cost. So we see here carrying cost increase with the increased level of current assets, the cost to store and finance the assets. So that's a cost called as a carrying cost. And the shortage cost decrease with the increased level of current assets and the cost to replenish assets. Trading or order cost and cost related to safety reserves, lost sales, lost customers, and production stoppages. So these are all called as a shortage cost. So altogether, we call them as a shortage cost. So there are two types of costs. So we have to make a trade off whether we go for a high carrying cost or whether we go for a high shortage cost. So the good managers have to try to create a balance between those. Now, we see here that how we determine we draw the carrying cost, because carrying cost is a very a linear relationship. Like as we are increasing our current assets, the carrying cost is going to increase and increase. So we see that we plot amount of current assets on x-axis. So as it is increasing, the carrying cost is increasing. But the shortage cost has an inverse relationship with the current assets. So if the current assets are increasing, carrying short is going to decrease and decrease. And we see here that relationship is a downward sloping relationship. And the ideal situation is that where they are equal, there's a balance. There is a balance, and that balance is where the total cost of holding current asset is minimum. That's a minimum point. So managers won't select this cost. We can also see in different policy scenarios, like if we are just the, I don't know why it's okay. So a flexible policy, we are having more assets in order to keep the firms more relaxed. And we see that we are incurring more carrying cost and less shortage cost. But if we are following a restrictive uh, policy, then what we are doing is we are trying to reduce the current assets. And by this way, we are trying to equate where the marginal cost, where the carrying cost and the shortage costs are equal. So temporary versus permanent assets. So temporary current assets sales or required inventory buildup are often seasonal, and we see the additional current assets carried during the peak time. And the level of current assets will decrease as sales occur. And permanent current assets are firms generally need to carry a minimum level of current assets at all times. And these assets are considered permanent because the level is constant, not because the assets are not sold, but because we have to keep the asset. And this graph is representing there's a time on x-axis and the dollar terms of cost on y-axis. And we see that these steep growth, general growth in fixed assets and permanent current assets over a seasonal variation, like there are some seasons like for summer or for uh, holidays, vacations in December. So that's we have to keep these seasonal changes. So total asset requirement is changing over time. It's not constant. So this portion is a seasonal variation portion, and this is our constant variation portion. Choosing the best policy, cash reserves, pros. If we keep the more current assets, so what is going to happen? Firm will be less likely to experience financial distress. That's as I mentioned, they become more relaxed, are better able to handle emergencies, to take advantage of unexpected opportunities. And the cons are that cash and the marketable securities earn a low returns and are zero NPV investment. Now, choosing the best policy is maturity hedging. The reason for this all what we are discussing is that how we can match current assets with the current liabilities. So try to match financing maturities with asset maturities. Like if there's a match, then there's no problem of distress. The finance temporary current assets with the short-term debt, and finance permanent current assets and fixed assets with the long terms. So if look at this graph again, so this seasonal variation should be financed through short-term debts, but this which is a constant or a permanent type of requirement, that should be financed through fixed assets, fixed borrowing or a fixed debt and equity. Now, relative interest rates, short-term rates are normally lower than long-term rates, so it may be cheaper to finance with the short-term debt. And also, firms can get into trouble if rates increase quickly or if it begins to have, difficult making payments, may be not able to finance the short-term loans. Have to consider all these factors and determine a compromise policy that fits the need of your firm. Now we see here that how we can finance. So there are three different types of policy options are available. Now one is a restrictive policy option, and where we see that we just are going to go for the permanent uh, asset, permanent current asset, and we are not holding and we are ready to bear the shortage cost. But if there is any seasonal variation, what we do, we use our marketable securities to sell and buy those variations. The other one is a compromise policy, the C policy. It is in between the other extreme, which is a flexible policy. In flexible policy, we cover this flexible or a seasonal variation through short-term financing. uh, uh, through short-term financing. And this flexible policy creates again a pressure or distress if the interest rate variate frequently, or there is a volatility in the interest rate that creates a distress for the company if we are taking short-term borrowing to cover all these seasonal variations. So flexible and restrictive policies, and in between there is a compromise in which we are covering the some portion of this flexible by marketable securities, and other one is uh, by by short-term financing. So this is the way that we can deal with those issues of current asset management or working capital management in the way. So this part we cover mainly the main idea behind that. What we want to cover here is uh, operating cycle, cash cycle, and then we also talk about the payable period and receivable period. So if I summarize, like operating cycle is a inventory period plus receivable period, that is our operating cycle. And if you want to calculate the cash cycle, so operating cycle minus payable period is a cash cycle.